Hey everyone, it's Hamish from the Young Investors Podcast. Myself and Brandon are excited to bring you your weekly rundown of the latest business and investing news from around the world. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing, make sure you reach out to a qualified financial advisor. But with that said, let's get into another episode of the Young Investors Podcast.
Hey guys, welcome back to the Young Investors Podcast. Hamish Hodder, how are you going on this lovely Friday?
I'm doing well. Yeah, still a little jet lagged, I think, from last week. I was I can't remember who I was telling it to, but it's because we only went for 1 week this time. We didn't actually have like the extra couple of weeks of time in the US. I feel like I never acclimatized to any time zone. So I feel like it's been a complete mess, but yeah, slowly getting there.
Well, we went from Australia time and then we basically flipped it on its head and then we stayed there for a week and then flipped it straight back. So yeah, we never really got, and you were hit a lot by the jet lag early on, but it was a very busy week, and we do have to apologize. We thought we were going to have time to do lots of podcasts as well in America. That did not eventuate because we were so busy in the end. So we're sorry that we weren't able to bring you a podcast while we're in America. Hopefully you guys still enjoyed the content that we were putting out on our YouTube channel. So you still felt like you got some coverage of the Berkshire Hathaway shareholder meeting. But yeah, overall, it was still a fun trip. And it was really, really great to hang out with you guys and meet a lot of you guys. So we always feel like we're kind of like little celebrities when we go to Omaha. It's the only time that it ever happens, but it's kind of mind blowing how many people we spoke to, and a lot of you guys that follow the podcast. So that was really, really fun. And just thanks to everybody that came and said hi. Yeah,
absolutely. Should we give a quick kind of summary of the trip before we get into the rest of the podcast today? We started out. We did our how many layovers do we have? Well, I was coming from Melbourne, so I had to go Melbourne to Sydney, and then we both left from. Well, you went from Canberra. You had to take a shuttle to Sydney, and then we both left from Sydney to LA to Minneapolis to Omaha. So there was a very long trek. I think the way over there it was maybe 26 or so hours traveling. So it was an exhausting trip over there. But we arrived, and what day did we get in? We got in on the Tuesday, I believe.
Yeah, Tuesday, and then we were pretty zonked for the next couple of days, and then things kicked off on the Thursday. So on the Thursday, we went to hang out with Matt Peterson at the Berkshire Barbecue, which was unfortunately not your typical barbecue this year. We were just in a high-rise building in Omaha, but it was great to see Matt again and hang out with him. And then that was Thursday. Then Friday we were at Value X with Guy Spear, which was really cool. Listened to Monsoon Probri do a talk. Monish was there as well. We got to listen to Charlie Munger's Secretary of 30 Years, which was really cool. That was really something special listening to her speak. Just basically just slamming Charlie the whole time. She was asked, like, do you ever think that Charlie would become such a legend? She was just like, no. So that was classic.
Yeah.
And then we walked around the Berkshire floor on Friday as well, the floor of the convention, and we met Ted Weschler, guys. Ted Weschler. So out of the 3 people that contribute to the Berkshire portfolio, it's either Buffett, Todd, or Ted, and we met Ted. How cool, Hamish?
Yeah, that was crazy because he was just kind of wandering around and no one was going up to him at all. We both kind of looked at each other like, wait, is that really him? because
him?
no one was trying to talk to him or take photos with him or anything. And for those who don't know, Ted's kind of fascinating story is that he put $70,000 into a Roth IRA, which is one of America's kind of like superannuation retirement funds. and he turned that $70,000 into $260 million. And I think he has the largest, amount of money in that account, because obviously there's like a limited amount of money you can put into that retirement account. So for most people, it doesn't go that high. But he has $260
So he's number one
million.
on the leaderboard.
He's on the leaderboard of the Roth IRA leaderboard. He's at the top.
That's wild.
He's got quite a track record in terms of his investing ability, and he's, as you said, he's one of the two other investment managers below kind of Buffett now at Berkshire.
Yeah. So that was really cool. Meeting Ted was great. That evening, we went to an aquamarine dinner with Guy and a couple of aquamarine shareholders as well. So that was really fun.
Yeah.
Then the next morning, it was the meeting. So it was the very early wake up at 3:30 in the morning, out to the South Gate, waiting with all you guys in the line, waiting with Guy and Matt and Monish and all the rest of them. Just that's always a good time. You're so tired and you desperately need a coffee, but it's still a good time.
Yeah. It's always a good. That gate is always a good gate to go to because everyone's there kind of to talk. Yep. But we did kind of get stitched up a little bit this year because they did not let people through that gate quickly at all. So we ended up sitting super far back, which it was actually not that bad because the previous 2 years we'd been on the floor, and they obviously just set up they just set up chairs on the floor, whereas we were now back up in the stands, and the chairs in the stands were actually really comfortable. So I didn't mind
cushioning.
I didn't mind being further back. Actually, it was kind of nice. Yeah.
Yeah, no, it was. It was definitely nice having a cushioned seat. But then we listened to the meeting, hung out with a lot of you guys, and then after that, there's not really too much to say apart from going to the meeting, because for the next 48 hours we just worked. We just did nothing but work. I literally didn't go outside for 48 hours because I was just head down working. Making 2 videos before we left.
And I think the only time I went out was like every 3 hours to the coffee shop right across the road from the apartment to go get another coffee.
I should have gone with you, but I just didn't. Oh dear. But and then we flew home, and here we are readjusting, and now we've recovered, and I thought there might be a lull in the news after the big Berkshire Hathaway shareholder meeting, but not the case, Hamish Hodder. We have a lot of news to talk about this week.
Yeah, it's as we kind of always say, it's there's always big weeks in finance and dull weeks, and this is certainly one of the weeks where everything seems to be happening. With, of course, we're going to talk about the meme stock return of GameStop and AMC. They're back. I'm sure most people have seen a little bit about that. We'll dive into some of the details. We've got US inflation data, and we have our quarterly 13F filings where we get to peek behind the curtains at some of the trades being made by institutional investors. So, it's all been happening. It's all been happening this week, and we're going to dive into it.
All right, let's do it, Hamish.
Today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news for thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings, and manage your portfolio by tracking your investments with price alerts so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors to try Seeking Alpha free for 7 days. Do you want to take us off by take us into the meme stocks are back? Tell us about what's going on.
Everybody get your gambling hats on. We're going to Vegas, everyone. So if I'm sure you have seen it, but if you haven't seen it, GameStop made some big headlines this week because, it looks like it's meme stock mania 2.0, Hamish. It looks like things are getting fairly frothy over there. Yes, you might have seen GameStop in the news. To jog your memory, this is the stock that was jumped on by the Wall Street bettors back in 2021. Essentially, they managed to buy enough shares to trigger a short squeeze. Retail buying caused the stock to rise from $5 to a high of $95. That's after the stock split. Those stock prices are after the stock split's been factored in. So they totally crushed the shorts, and it made select few retail shareholders a hell of a lot of money. And one of those retail shareholders was, of course, a man called Keith Gill, who goes by the online name of Roaring Kitty, and he was one of the key figures that encouraged a lot of the retail traders. So he ended up turning $50,000 into $50 million, Hamish. $50 million. That is ridiculous.
Yeah.
But then, of course, when you make a lot of money in that short space of time, people get annoyed at you. and the problems came for Mr. Gill. He ended up getting sued. He had to testify before Congress. It ended up being way more than just a bet on GameStop, and ultimately stopped posting to the internet. And then over the next 3 years, GameStop shares just were basically in constant decline. In fact, the shares fell about 90% from their 2021 highs. So the meme stock craze had definitely lost their leader, and it definitely started to fizz out. And the companies, GameStop, AMC, BlackBerry, etc., their share prices started to fall to where that probably you could argue they should be, a lot lower than where they were. But then, Hamish, last week, last week there was quite a rise in GameStop shares. They went from 10 to 17 off of no real news, but then it was actually this week on Monday that it really took off. And that's because Roaring Kitty, out of nowhere, decided to post online for the first time in 3 years. So he ended up posting a picture. Well, he posted a couple of movie clips as well, but really he posted a picture, a meme of the video gamer going from a relaxed position to the competitive position, like leaning forward on his knees. And everybody on Wall Street, like Wall Street bets, just went crazy, and they all started piling back into this stock. There are some bits of evidence seems to suggest that it's not as much retail this time around and more institutional, but nevertheless, this post by Roaring Kitty somehow triggered the stock price of GME to rise 74% on Monday. Yeah. 74%.
It's insane. It's absolutely ridiculous that you can, a person can post something on Twitter and make a company's value change by multiple billions of dollars. That's absolutely insane. And you're right. It does seem like there's quite a bit of more institutional involvement this time around. But I wouldn't be surprised if a lot of that institutional involvement is off the bat of what's happening on Twitter as well. So
probably
it does just kind of show you. It's wild to see that a single tweet can really just kick off this take us right back into 2021 again.
It was reported on CNBC on Monday alone, short sellers lost close to $1 billion. But where it gets really insane is that then we wake up on Tuesday, and on Tuesday the shares rise another 60%. So overall the shares in 2 days climbed from 17 to 48. Now, thankfully, that seems so far to have been all of it, because the following day the shares fell 20%. Last night they fell another 30%, so it's back down to 27. So it seems like maybe it was just a flash in the pan, although the stock is still a lot higher than where it was. It's at 11 on the 1st of May. It's at 11 on the 1st of May. It's at 27 now, so it's still a lot higher. So people are speculating this could be another short squeeze. I think it's important to remember that in 2021, 130% of the float was held in a short position. This time around, it's still high, but it's nowhere near that. It's about 24%. So although it's, anything kind of over 20, you're starting to say, wow, this is quite a heavily shorted stock. It's still nothing like what we saw in 2021. That was really a special case. So that is kind of what is happening with GameStop. The only thing that I wanted to touch on apart from that is that it's not just GameStop. We also saw AMC rise 135%, BlackBerry rose 20%, Tupperware rose 60%. So all the meme stocks, Hamish, all of them are up. It's
just such a funny,
ridiculous.
It's just such a funny collection of stocks. Like you've got like a video game, physical retailer, a movie chain, like a cinema chain, BlackBerry, like a phone company, and then Tupperware. Like it's just like the most random collection of businesses.
So silly. The only other thing I wanted to touch on quickly, Hamish, is that a lot of people are saying that AMC took the opportunity to raise money, which is such a funny idea. It's like the memesters save you, and the stock gets bid up, and then while the stock's up, you do a capital raise. That seems to be what happened. That it was reported by Bloomberg that on Monday, after surging 78%, AMC had completed a $250 million capital raise and sold 72.5 million fresh new shares at an approximate price of $3.45 per share. So it sounds like when you just read that headline that the stock price went up and they've just cashed in immediately. AMC does have this clever fundraising deal known as an at-the-market offering, which lets it create new shares kind of opportunistically, and then they sell it whenever they want to buy us in the open market.
Yeah.
So it's essentially if something like this were to happen where the stock price goes up suddenly, they can just do it, and the investors kind of agree how much they can do that prior to them doing it.
Yeah.
They had done that, except it seems a little bit misleading to say that they raised $250 million when their stock was up 78%, because it did say that the average price was approximately $3.45 per share. And I wrote it down here. On Monday, the share price went from $2.95 to $6.42. So in reality, probably most of that raising was done prior to this, and maybe they just polished it off when suddenly the share price went up a lot. But the average price is $3.45.
Yeah. I mean, AMC as a company has been burning cash ever since the pandemic. And so there's just been, a constant need for them to raise capital. And when you're burning so much cash and you're right near bankruptcy, it gets difficult to get debt. So companies like that tend to take any opportunity they can to sell additional shares to raise some capital. I was just trying to look at how many shares outstanding AMC has. So back in 2020, they had 24 million shares that existed. So you can think of that as like the pizza or the pie has been cut up into 23 million pieces. Today, they have 300 million. So the dilution essentially has been, more than 90%. One share has lost like 90% or more of its value simply from them just creating new pieces to sell to new investors.
Wow.
So I think that gives you an idea of just how desperate the situation is for AMC. So it's not surprising that every time they seem to get a price that kind of pops on retail or like this meme kind of frenzy, they're taking every advantage they can to try and raise as much money as possible and survive.
Cross their fingers and hope they make it.
Yeah.
All right, Hamish, well, that is everything with the GameStop news that happened during the week. We'll see what happens over the next week. I'm not going to take a stab and say where I think a GameStop will be in a week's time. It could go anywhere, but at least for now, it looks like it's cooling back down. All right, Hamish, let's go on to the 13F filings. Let's look under the behind the curtain at what the biggest investors in the world were buying and selling in Q1. And it starts with Buffett. Buffett, although we went to the Berkshire meeting and we've already reported on this big Apple kind of sell, that's not the only bit of news to talk about out of the 13F for Buffett. No,
not at all. It's a massive quarter for the 13F filing for Mr. Warren Buffett and Berkshire Hathaway, and we'll talk about some of the things that we already heard from the meeting. We haven't spoken about them on the podcast, but we spoke about them in our YouTube videos and that sort of thing. But there was one thing first that wasn't spoken about at the meeting, and that was his secret stock that he's been acquiring for the past 2 quarters has finally been revealed. So Buffett was granted confidential treatment, which allowed him to keep the name of a stock that he's been acquiring for a couple of quarters secret. This is something that he does very occasionally. It's not a normal practice. I think the last time he did it was in 2020 with Chevron and Verizon. But sometimes if he's going to make a big investment and he doesn't want the stock to move on the news that he's buying it before he can kind of build his position, he'll ask for special treatment. And that's what he's been doing for the past couple of quarters. it was kind of already speculated that the stock would likely be a bank or an insurance company. And that's basically because when the first quarter earnings results were released a couple of weeks ago, Berkshire's cost basis for their bank, insurance, and finance equity holdings increased by a few $billion. So it seemed like this kind of hidden secret stock that Berkshire had been acquiring was very likely either a bank or an insurance or some other kind of finance company. And it was. Today it was revealed that the company that they've been acquiring shares in is a company called Chubb, which is a Zurich-based insurance provider. And it's a massive insurance provider valued at about $100 billion. So Berkshire's been, over the past couple of quarters, since Q3 of 2023, he's now acquired 26 million shares worth about $6.7 billion. Which makes it his ninth biggest stock position, about 2% of the stock of his kind of equity portfolio. So it's a pretty big investment that he's been making, and we finally know who it is.
That is significant, Hamish. That is significant, and right in Buffett's wheelhouse, I would say.
Yeah, not too surprising. I mean, it would have been nice if it was, something unique that, or like, that we maybe didn't see coming, or I think some people were speculating it was like Disney or something like that, right? Something a little bit more fun than just another insurance business. But yeah, it's certainly in his wheelhouse.
Too bad.
And to give you an idea of why there's special treatment to the kind of confidentiality is important for Berkshire Hathaway. As soon as this was announced, the stock was up 8% in after hours. And I don't know, maybe you can pull it up while I'm talking, how the stock actually moved. But certainly he has the power to move markets when he's making investments. Pretty, multiple billions of dollars.
Yeah. When did these come out? They came out, so it's up since on Wednesday. On Wednesday it's up 3.87%.
Okay, so it kind of came back in a little bit, but there you
interesting.
go. So it's Warren Buffett and it's Roaring Kitty, the two people who can move markets. Warren Buffett and Roaring Kitty, who's the Warren Buffett of Wall Street bets.
Lol.
Yeah.
Oh, sorry, Hamish, I read that wrong. It's up 3.87% in the last 5 days. Across the last day, it's up 4.71%.
Okay.
So
there you go.
Yes, Warren Buffett certainly has the ability to shift a market. It's crazy that he gets special treat. I mean, it blows my mind that the SEC doesn't just say, "Oh, too bad, so sad." Like, so what? If you want to buy some stock and then it comes public information, like, so be it. You should have bought more sooner. Like, come on. But no, he must have some a high reputation, a little bit of sway in the old SEC, because he does get this special treatment time and time again, which is interesting. They allow him to build out that position before he tells everybody what's going on. But I guess it is for this reason.
Yeah, I don't know of any other examples of other investors getting that treatment. I'm sure it's probably happened, but I don't know of any off the top of my head. So it's a pretty rare kind of thing. So that was it. That was the secret stock. There was a couple of other pretty massive moves from Berkshire Hathaway. They trimmed 13% of their Apple position, their largest position in the equity portfolio. We did already know this from their quarterly earnings, which was released over the Berkshire Hathaway shareholder meeting last week. And then at the meeting, in the Q&A session, he also answered a bunch of questions around why he was trimming Apple, and kind of gave two. You could probably summarize it into kind of two key reasons. One was he's not really seeing any good opportunities in equity markets at the moment with where kind of valuations are, and considering that that treasury bonds, like a 1-year treasury bond, is yielding more than 5%. So having money in cash or on the sidelines isn't doing nothing at the moment. It's earning actually a meaningful return. And for Berkshire, I think he has over $100 billion on the sideline, $190 billion or something like that. So, even at $100 billion in 1 year treasuries, for example, that's like $5 billion a year. So, it's not nothing. It's pretty meaningful to Berkshire as a business in terms of producing more income. But then the main thing that he spoke about was taxes. So he essentially expects that taxes on capital gains will rise, and he wanted to therefore realize some of Apple's $100+ billion capital gain before those increases go through. So that was kind of the main. It seemed like that was the main reason that Buffett was giving to trim a little bit, lock in some of those gains.
Yeah, so un-Buffett-like to make that kind of macro bet. Like he literally, we were sitting there. We know firsthand. We were sitting there in the audience as he was telling us that he wants to sell Apple because he wants to hold more cash right now, and because he thinks that in the future the tax rate might go up. I think now it's at 21%. It's historically gone as high as 50%. He thinks that to deal with the massive debt pile and the deficit that the US government has, they are going to have to raise taxes a lot. He anticipates that. So he literally said, I'm going to realize some of our gain in Apple now and pay a 21% tax rate because I don't think I'll get that opportunity again in the next little while, which is mind-blowing.
It was interesting to hear that because that does come across as more of like a macro prediction. Yeah. For example, in the US corporate, so capital gains for companies since 1990 to about, I think it was 2018, was 35%. So for a very long time, the capital gains rate for corporations was 35%. It's only very recently that it's been kind of lowered to 21%. So, even looking at from a historical perspective, companies historically over the long term have paid a larger amount in capital gains. So it seems like that kind of plays a consideration as well. And it's actually funny, a couple of days after the meeting, Biden announced specific plans for raising the capital gains tax. And also an unrealized, potentially a tax on unrealized gains, which was kind of interesting to see that as well. But yes, it does look like Buffett might be right that taxes, particularly for corporations, will potentially be going up. So he wanted to lock in some of those gains.
Is there anything else for Buffett this time around?
Yes, it was, as I said, very eventful quarter. They also sold, in the 13F filing, we can see that they sold 88% of their Paramount investment. And then at the meeting last week, they actually revealed that they'd sold all of it. So they're completely out of their Paramount position. Buffett said that the trade was entirely him, and essentially admitted that they kind of lost a pretty significant amount of money on the trade and that it was a mistake. But he cleared up that it wasn't Ted and Todd, which it was a little bit speculated that Ted and Todd had been in the driver's seat of that investment, but Buffett cleared that up. They also exited their HP investment, although this one only represented 0.2% of the portfolio anyway. And then the last thing was they added another 35 million shares of Liberty SiriusXM to now have almost 100 million shares in Liberty SiriusXM. We spoke about that a couple of weeks ago on the podcast, so we won't kind of go too much into that, but that's his risky arbitrage play on the potential merger between Liberty Sirius shares and SiriusXM shares. So if you want to hear our kind of discussion on that, it was a couple of weeks ago.
Yeah, very interesting. And then I've kind of just got some other investors to quickly run through, but it's kind of like what Buffett said, he's not finding great opportunities, and that flows through because all these investors kind of invest the same. They're all like value-oriented investors. You kind of see that theme going through the rest of the 13Fs. Like Lilu did absolutely nothing. Guy Spear did only one thing. He reduced 25% of his Ferrari position. Bill Ackman reduced 10% in Chipotle, which is his biggest stock, which is biggest US stock, which is interesting. Howard Marks didn't really do anything at the top end of Oaktree's portfolio. That's a big portfolio though, but nothing notable. Seth Klarman also did very little at the top of the Baupost portfolio. One notable thing is he, like Berkshire Hathaway, was in on the Liberty Sirius potential arbitrage. However, it looks like he's exiting that now. He reduced 70% in Liberty Sirius XM Series C and Series A. So Buffett's going in, Klarman's getting out. So make of that what you will. Monish Prabrai, he added just 2% to his largest US holding, that's Alpha Metallurgical Resources, and he reduced Warrior Met Coal by 25% and Arch Resources by 40%. And I think, honestly, like maybe one of the more interesting ones was Michael Burry.
He never disappoints.
He never disappoints. Yeah, as we've said in the past, there's a limited amount you can take from Michael Burry's 13F because obviously he chops and changes so much. It's kind of like a trader. Whereas with a 13F like Buffett, it's more of like long-term picks, so you can take more out of it. But even still, there were a couple of themes. He continued to buy the Chinese tech giants. The JD.com and Alibaba are the ones that he continued to add to. He also bought a new stock in Baidu. So he's continuing that kind of bet on Chinese tech. JD and Alibaba are the two largest holdings in his portfolio at 9.5% and 8.7% respectively. And then he also added 25% to his third and fourth largest positions, that being HCA Healthcare and Citigroup. And interestingly, he opened up a new position, which I think is now his fourth or actually it would be his fifth largest position in Sprott Physical Gold Trust, which, as the name suggests, buys and holds physical gold. So interesting. Is Michael Burry maybe having a little bet that, or maybe a little hedge that the world might fall apart? That seems like it's up his alley, right?
Yeah, well, the implication of having a large gold position would be that that inflation is going to get worse again, as gold has very historically been a solid currency hedge for currency devaluation. And that also wouldn't be surprising given, some of his past tweets talking about the 70s and 80s inflation period and kind of just making sure everyone's aware we should be very cautious of, easing monetary policy too early and therefore causing a second worse spike of inflation. But unfortunately, we don't know exactly his thoughts because he's not on Twitter anymore. He's been absent. I think everyone in the finance community's obsession with him kind of scared him away. So
yeah, maybe.
So I think to be fair, like over his Twitter lifetime, he goes through these periods where sometimes he's very active and then sometimes he disappears for a year or 6 months or something. So hopefully he'll come back at some point.
We'll see.
We'll see.
I hope so too.
Yeah, I hope so. But we'll see.
We need to make the content, Hamish. That's it. We need him to come back for the content, for the memes. That's the main reason.
Yeah.
We need to make money off of this.
Exactly.
He's an interesting guy. But yeah, you're right. He must be seeing something brewing in the market, or he just wants that inflation hedge, as you say. Because, it's not like gold is cheap right now. I think it's like all-time highs.
Yeah, exactly. And, if that's all for Mr. Michael Burry, speaking of inflation...
It is. Here we go.
We did get some inflation. we got a good segue. We did get the latest inflation data out of the US this week as well. So consumer price index for April 2024 came in at 3.4% year over year and a 0.3% month over month rise. So again, US Fed's target for inflation is 2%. I think Australia's target is a range of 2 to 3%. And US inflation is at 3.4%. So, it's still high, 50, 60, 70% higher than ideally it should be. But it's obviously in a much better place. And I think this is generally considered a good news for in terms of a monthly inflation release. As I said, the month-over-month rate was 0.3%. Which is slightly slower than 0.4% last month. So the concern so far this year has been that since October last year, the month-over-month rate of inflation has been steadily increasing. So to see that moderate kind of slightly to 0.3% is good news. Core CPI came in at 3.6%, so slightly higher than overall headline inflation still, but much closer to headline inflation now. And on a month-over-month basis, core CPI was also up 0.3%. The biggest contributors during the month were mostly related to energy. So gasoline was up 2.8% in the month. Fuel oil was up 0.9% in the month, and transportation services was up 0.9%. So those are the biggest drivers of inflation in the month of April so far. What does this mean for interest rates? I think is probably the question that everybody has when they are taking a look at the new inflation data. On Tuesday, Fed Chair Jerome Powell acknowledged that readings earlier, the readings earlier in 2024 had been higher than expected, and said it's likely the central bank will need to keep monetary policy at the current rate for longer than it had been thought. And if we look at financial markets, markets are now estimating that the first rate cut won't be until September. So, throughout the year, clearly at the start of the year, everyone thought inflation has been decreasing very, very quickly. There's going to be a number of rate cuts. And as the year has kind of progressed, that expectation is kind of moderated to the point now where we're looking at maybe the first rate cut in September. But as we always say, nobody knows what's actually going to happen. It was only a month or so ago that we thought the first rate cut was going to be in June. And about a month before that, people thought it was going to be in March. So that expectation has just shifted, and that's all we can do when it comes to this macro data is just watch it and observe it, and don't take too much into what is expected to happen over the next few months.
Yep. Don't try and predict it. Don't believe in anybody else's predictions. Even the Federal Reserve, don't believe their predictions either, because they're wrong. It's crazy. Like I always say, they've got their hand on the lever that can change interest rates, and they don't even know where interest rates are going to be in the next few months. Like it's silly to trust predictions or even to try and make predictions in that realm. It's just it's important to keep on top of and understand what's happening. Like it's good to see, I guess. It's good to understand that, over the last few months, the inflation has been slowly worsening on a month-over-month basis, and it's good to see now that it's gone the other way slightly. It's good to know that, but when it actually comes to your investment decisions, it shouldn't have an impact at all.
Yeah, exactly right.
All right, guys. That is it. That is it for today's podcast. We have covered everything, Hamish. So well done in record time. Not quite, but we've. Truth be told, we can tell the story, right? We've actually already recorded this podcast. Unfortunately, my audio decided to absolutely just not work. That's all I can say. Well, my audio just was terrible.
We I don't think we've had an issue with the microphones in a very long time, right? I can't even remember the last time that we've had to re-record an episode. So we've luckily we've had a very good run, but yeah, when you make 250 episodes of a podcast, there's going to be one or two in there that where something goes wrong. So it is what it is.
It was good talking to you about this stuff again, Hamish.
Yeah. We had a rehearsal. We had a rehearsal run.
Yeah, we had a rehearsal. Exactly. It's always good for a refresher. But anyway, guys, thanks very much for tuning in. We hope you still enjoyed the podcast. Thanks, Hamish, for showing up, even though we recorded the podcast yesterday. And hope you guys enjoy, and we'll talk to you guys very soon. We'll see you guys next week.
See you guys.